macro currency signals.
I've been watching this market for a long time, and I want you to lean in for a second because what I'm about to say is not about a chart pattern, not about a moving average crossover, not about whether silver is up $2 this week or down $3 next week. This is about something much bigger. This is about a system that is mathematically cornered, structurally strained, and quietly transitioning into something most people are not prepared for. Let's start with the uncomfortable math. The headline debt number that gets thrown around sounds massive on its own. Trillions stacked on trillions, but that number is just the visible portion. When you add the promises that aren't fully funded, the long-term healthcare obligations, retirement systems, guarantees, and future commitments, the real liability is exponentially larger. We are not talking about a tight budget. We are talking about obligations so large that in constant purchasing power, they cannot realistically be repaid. Now pause and think about that carefully. How do you repay enormous long-term obligations in a country that no longer produces at the scale it once did? How do you generate the productive output required to service that level of debt when your industrial base has been hollowed out over decades? Manufacturing didn't just slowly drift overseas by accident. It was incentivized, it was encouraged, it was rewarded by a system that made it cheaper to produce elsewhere and import the finished goods back home. And that connects to something deeper, the global reserve currency structure. Before we go any further, if this makes sense to you, make sure you're subscribed and turn on notifications. Being early really matters in times like this. Leave a comment and let me know where you're watching from and what time it is where you are. This is a global conversation, and it's amazing to see how far it reaches. All right, now let's get back to what just happened. When your currency is the one the world uses for trade, settlement, and reserves, it creates a paradox. The world needs more of your currency than you can supply through balanced trade alone. So you run persistent trade deficits. Dollars flow outward. Foreign countries accumulate them, and instead of letting those dollars sit idle, they recycle them into your government debt. That keeps your interest rates lower than they otherwise would be. For decades, that system created a strange illusion of prosperity. Goods were cheap, credit was cheap, asset prices rose, homes appreciated, stock portfolios swelled, retirement accounts looked healthy, it felt like growth, but much of it was financial growth, not productive growth. It was leverage layered on top of structural privilege. While factories closed, asset prices soared. While production declined, consumption expanded, and the gap was filled with debt. That system works until it doesn't. Because the very mechanism that keeps interest rates suppressed also encourages fiscal excess. When borrowing is cheap, discipline erodes. When the world eagerly buys your debt, deficits seem painless. But compounding interest does not care about narratives. It compounds anyway. Now layer in a second force, technological acceleration. Artificial intelligence and automation are not theoretical anymore. They are not coming someday. They are here, and they are improving exponentially. Entry-level white-collar roles, analysis, bookkeeping, compliance review, administrative coordination, are increasingly replicable by machines at near-zero marginal cost. If a machine can perform in seconds what used to justify a full-time salary, what happens to those wages? What happens to the tax base? What happens to consumer spending? This is where the so-called K-shaped reality emerges. Efficiency and capital ownership concentrate gains at the top. Productivity increases dramatically for companies that successfully integrate automation. Margins improve. Costs shrink. But displaced labor does not instantly transform into high-skill innovation roles. There is friction, there is lag, there is stress. So now imagine this landscape. Massive long-term debt obligations, a diminished industrial base, technological displacement of large segments of the workforce, and ongoing fiscal deficits required to stabilize social pressure. Does that look cyclical to you? It isn't. It's structural. Structural problems do not resolve with a single rate cut. They do not disappear because inflation ticks down for a quarter. They do not reverse because a market rallies for 6 months. Now let's pivot to something that doesn't get enough mainstream attention: gold. Gold does not move because of headlines alone. It moves because of positioning, and for years, central banks around the world have been accumulating gold at levels not seen in decades. That is not retail speculation. That is not momentum trading. That is strategic allocation by institutions that think in decades, not days. Gold has no counterparty risk. It cannot be printed. It cannot be digitally frozen. It does not rely on the promise of a government to maintain its intrinsic nature. It simply exists as a monetary anchor. At the same time, the physical flows tell a story most people ignore. Large quantities of gold have been moving across borders. Warehouses have been seeing significant inflows and outflows. Physical delivery demand has been elevated. That is not noise. That is not random. Someone is positioning. And while retail investors argue about whether gold is overbought, Large, well-capitalized entities are taking possession. Now let's talk about silver. Silver is not just a monetary metal, it is an industrial metal. It sits at the intersection of two worlds, store of value and technological necessity. It is essential in electronics, solar infrastructure, advanced circuitry, electrification systems, medical equipment, defense components. Modern civilization quietly runs on silver's conductivity. Yet the silver market is tiny relative to global capital pools. That is critical to understand. The entire annual silver supply represents a fraction of what flows daily through bond or equity markets, which means when physical tightness develops, when industrial demand collides with investment demand, price discovery can shift violently. We've already seen unusually large physical delivery volumes in recent months. That matters, because every ounce taken off the exchange and placed into long-term storage reduces available float. And when available float shrinks in a small market, price elasticity increases dramatically. Most people assume price leads narrative. Often it's the opposite. Positioning leads price. Narrative follows later. Now zoom out. If sovereign entities are accumulating gold, if silver is being classified as strategically important, if global trade is slowly diversifying away from exclusive reliance on one settlement currency, if fiscal pressures are rising, if technological disruption is compressing wage growth, what kind of monetary environment does that create? It creates one where currency debasement becomes the path of least resistance. Governments, historically, do not default openly on large debt loads when they control the currency in which that debt is denominated. They inflate. They extend maturities. They engineer financial repression. They keep nominal rates lower than real inflation for sustained periods. They allow the purchasing power of debt to erode gradually. And in those environments, tangible assets tend to outperform paper promises. This is not fear-mongering. It is historical pattern recognition. Gold tends to move first. It senses monetary stress early. Silver often lags and then accelerates. But here is where my 2026 silver prediction becomes controversial. Most stackers are conditioned to believe silver's breakout will be explosive and immediate, triggered by a dramatic currency collapse or a sudden systemic failure. They expect chaos. They expect overnight repricing. I do not. I believe the path is more strategic. I believe silver is being accumulated quietly in preparation for its industrial indispensability in an electrified, AI-driven, infrastructure-heavy world. I believe the supply-demand imbalance will build gradually, masked by paper trading and leveraged derivatives, until one of two things happens. Either physical delivery pressure overwhelms available inventory, or industrial buyers panic-secure long-term contracts at significantly higher prices. When that moment arrives, the repricing will not be polite. But here's the surprise. I do not think silver's ultimate move in 2026 will initially be driven by retail stacking enthusiasm. I think it will be driven by institutional and sovereign allocation shifts. Capital pools so large that even a small percentage reallocation into physical silver creates disproportionate price impact. And here's the part most people miss. Silver does not need hyperinflation to move dramatically. It simply needs recognition of scarcity under structural demand growth. If industrial demand continues climbing, if monetary uncertainty persists, if central banks continue diversifying reserves, if fiscal deficits remain entrenched, if real rates stay suppressed relative to inflation, then silver doesn't have to moon overnight to shock people. It can grind higher, compress supply, and then surge when liquidity tightens. 2026, in my view, becomes the convergence year. Debt rollover pressures intensify. Technological displacement reshapes labor markets. Energy transition spending accelerates. Geopolitical realignments deepen. That convergence creates volatility. And volatility in a small physical market like silver magnifies price discovery. Most stackers are preparing for a single vertical spike. I'm preparing for a structural repricing cycle. And here's the most important part. This is not about getting rich quickly. It is about preserving purchasing power in a world where nominal promises cannot realistically be honored in stable dollars. When debt grows faster than productivity, something must adjust. Historically, it is the currency. And when currency adjusts, hard assets reprice. Silver, because of its dual identity, monetary and industrial, sits in a unique position. It is not just a hedge, it is a strategic material. So while headlines debate quarterly inflation prints, while analysts argue about rate cuts, while commentators obsess over daily volatility, the deeper forces are moving beneath the surface. Debt is compounding. Technology is displacing. Central banks are accumulating. Physical metal is shifting hands. That is not random. That is transition. And transitions create winners and casualties. Most people imagine silver's breakout as a panic event, a currency crisis, a banking freeze, a weekend shock announcement, limit up futures markets. Dealers sold out in hours. That scenario is possible, but it's not the highest probability path in my view. The more dangerous scenario, and the one far fewer are positioned for mentally, is controlled instability. Slow burn debasement, managed volatility. Policy adjustments that look stabilizing on the surface but quietly accelerate the long-term repricing of hard assets underneath. Let's walk through what that could look like. First, the debt rollover cycle intensifies. Large tranches of government obligations mature and must be refinanced. If rates are materially higher than when that debt was originally issued, interest expense balloons. The budget strains further. The solution cannot be austerity alone, because the political appetite for severe contraction in a technologically disrupted labor market is minimal. So what happens? Yield management. You won't hear the words financial repression shouted from podiums. You'll hear phrases like stability measures, liquidity support, orderly market functioning. But the outcome is the same. Rates are influenced downward relative to inflation. Real rates remain compressed, and when real rates are suppressed long enough, capital begins searching for protection. Now imagine this unfolding alongside accelerating electrification mandates, grid modernization projects, defense production expansion, and AI data center proliferation. These aren't fringe trends, these are multi-trillion-dollar infrastructure shifts. And silver is embedded in nearly all of them. Solar installations require silver paste. High-efficiency electrical contacts require silver, advanced chips require silver, medical sterilization systems require silver, military communications hardware requires silver. And here's the critical detail. Much of that silver is consumed, not stored. Unlike gold, which sits in vaults for decades, silver is dispersed across industrial applications. Recycling captures some of it, but not all. And as technology becomes more distributed, more devices, more electrification, more miniaturization, cumulative demand increases in subtle but persistent ways. Now combine that with another force, investment psychology. In the early stages of monetary stress, investors prefer assets perceived as stable and liquid. Large cap equities, government bonds, even gold, because gold has a deeper market and more established institutional channels. Silver often lags in that initial flight to safety phase, and that lag creates complacency among stackers who expect immediate confirmation of their thesis. Here's the twist. The lag is the coiling phase. While price appears range-bound, physical inventories continue tightening. Delivery volumes remain elevated. Long-term contracts quietly secure supply. Industrial buyers begin paying premiums not yet fully reflected in futures pricing. Paper markets can suppress price signals temporarily. They cannot manufacture physical supply indefinitely. If exchange inventories fall below comfort thresholds, if lease rates spike, if delivery timelines extend, suddenly the paper market loses credibility. And when credibility erodes in a thin market, repricing is violent. But here is where 2026 becomes pivotal. By that point, AI-driven productivity gains are likely to be widespread. Corporations that successfully integrate automation will report strong margins. Equity indices may appear resilient. On the surface, the economy could look stable enough to avoid panic. That stability narrative is crucial because it delays retail rush into silver. Instead of a manic blow-off top driven by fear, silver could experience a structural climb driven by institutional allocation and industrial necessity. Imagine pension funds reallocating a fraction of a percent toward strategic materials exposure. Imagine sovereign funds diversifying small slices into physical-backed vehicles. Imagine manufacturers securing multi-year supply at progressively higher price floors. Silver does not need mass hysteria to double or triple from suppressed levels. It needs steady capital inflows in a market with limited float. And here's the part that will surprise almost everyone. I believe silver's breakout, when it accelerates, will initially frustrate many stackers, because it may not look like a clean vertical spike. It could look like a grinding staircase ascent punctuated by sharp pullbacks engineered through derivatives markets. Each dip shaking out weak hands, each rally building higher structural support. Those waiting for a single parabolic moonshot might sell too early out of impatience. Those over-leveraged expecting immediate explosion might be forced out during volatility squeezes. Meanwhile, physical holders who understand the macro arc simply hold through the noise. Now let's talk about currency mechanics. If fiscal pressure remains entrenched, policymakers face limited choices. Raise taxes aggressively in a slowing labor market, politically toxic, slash entitlements, socially destabilizing, default outright, systemically catastrophic. That leaves inflationary erosion, not runaway hyperinflation necessarily, but persistent currency dilution, enough to reduce the real burden of debt over time. In that environment, tangible assets with supply constraints gain relative strength. Gold reflects monetary anxiety first. Silver amplifies it when confidence in policy control weakens, and confidence is a fragile thing. If geopolitical blocs continue diversifying trade settlement mechanisms, even incrementally, reserve demand shifts. Not overnight, but gradually. Reserve shifts don't have to be dramatic to matter. A few percentage points redirected into alternative stores of value can create significant pressure when scaled across global trade volumes. And if some portion of that reserve diversification spills into silver, particularly under the justification of strategic industrial necessity, price discovery changes permanently. Now consider something else. Most stackers view silver purely through a monetary lens, but by 2026, silver may be reclassified in public discourse primarily as a strategic industrial bottleneck metal. That narrative shift matters. When policymakers and institutions frame silver not just as a hedge, but as a supply-critical component of national infrastructure and defense resilience, stockpiling becomes rational policy, not speculative behavior. Stockpiling reduces available float. Reduced float increases volatility. Volatility attracts capital. Capital amplifies price. And because the market is small, it doesn't take trillions. It takes perception and incremental allocation shifts. Here is my core prediction for 2026. Silver will not move because the system collapses overnight. Silver will move because the system strains persistently. It will move because debt remains structurally unmanageable in real terms, because real rates remain constrained, because industrial demand compounds, because supply growth fails to keep pace, because institutional capital slowly recognizes asymmetry, and when that recognition reaches a tipping point, the repricing window will be narrow. Most will chase after the move has already begun. Now let's address risk honestly. Could silver remain range-bound longer than expected? Yes. Could paper markets continue suppressing signals? Yes. Could global recession temporarily dampen industrial demand? Yes. But here's the counterbalance. Mining supply is capital-intensive, slow to expand, and often dependent on byproduct economics from base metals. If economic slowdown constrains base metal production, silver supply can tighten even as demand rebounds later. That asymmetry favors long-term holders. And here's the real shocker for many stackers. I do not believe 2026 will mark the peak. I believe it will mark recognition. Recognition is different from climax. Recognition is when institutional capital admits silver is structurally underpriced relative to monetary expansion and industrial dependency. Climax comes later, when retail finally floods in. The surprise is that the explosive narrative most are waiting for might actually lag the smart money positioning by months or years. By the time social media is euphoric, the foundational move will already have occurred. So what do you do with that? You stop obsessing over daily candles. You stop demanding immediate gratification. You stop assuming volatility equals failure. You understand that structural transitions take time until they don't. And when they don't, price adjusts rapidly. Silver's small market size is both its weakness and its strength. Weakness, because it is easier to suppress. Strength, because once suppression fails, it reprices brutally. 2026, in my assessment, is the year suppression begins to lose effectiveness. Not because of chaos, because of arithmetic. Debt arithmetic, supply arithmetic, energy arithmetic, technological arithmetic, and arithmetic always resolves. The question is whether you're positioned before resolution becomes obvious. We are living through a structural monetary transition disguised as normal volatility. Debt continues compounding. Technology continues displacing. Currencies continue stretching under promises that cannot be kept in constant purchasing power. Meanwhile, gold is being accumulated strategically, and silver is being quietly absorbed by both industry and long-term holders. My 2026 silver prediction is not about hysteria. It's about convergence. It's about recognition. It's about a small market colliding with big capital in a world that cannot inflate forever without consequence. When that recognition hits, it will feel sudden, but it will have been building all along. The surprise won't be that silver moves. The surprise will be how few people understood why before it did.